Welcome to Business with Louis, the show where we explore the latest ideas and strategies to help you succeed in the world of business. Today, we're going to talk about tax-efficient investment strategies, a crucial concept that can help you maximize your returns while minimizing your tax liability. As an entrepreneur or investor, it's essential to understand how taxes can impact your bottom line. Tax-efficient investment strategies is all about making informed decisions to reduce the amount of taxes you pay on your investments, thereby increasing your overall wealth. To start with, let's define what tax-efficient investment strategies is. Simply put, it's an approach to investing that takes into account the tax implications of different investment decisions. This involves considering factors such as tax rates, deductions, and credits when choosing investments, as well as strategies for minimizing taxes on investment gains. One of the key principles behind tax-efficient investment strategies is the concept of tax-deferred growth. This means allowing your investments to grow without paying taxes on the gains until you withdraw the funds. For example, if you invest in a 401 or an IRA, the money grows tax-free until you retire and start withdrawing. Another important principle is tax loss harvesting. This involves selling investments that have declined in value to realize losses, which can then be used to offset gains from other investments. By doing so, you can reduce your overall tax liability and minimize the impact of taxes on your investments. Influential thinkers and economists have contributed to our understanding of tax-efficient investment strategies over time. For instance, Nobel laureate William Sharpe developed the capital asset pricing model, which helps investors understand the relationship between risk and return in different asset classes. More recently, researchers such as Burton Malkiel and Charles Ellis have written extensively on the importance of tax efficiency in investment decisions. One notable example is Warren Buffett's investment strategy, which has been widely studied and emulated. Buffett's approach involves buying high-quality companies with strong growth prospects and holding them for the long term, thereby minimizing taxes on capital gains. Another example is the Vanguard Group, a leading investment management company that's pioneered low-cost index funds and tax-efficient investing. By using a passive investment approach and minimizing turnover, Vanguard has been able to reduce taxes on its funds and deliver higher returns to investors over time. In addition to these examples, there are many practical applications and tips for implementing tax-efficient investment strategies in your own ventures or careers. One key takeaway is the importance of diversification. By spreading your investments across different asset classes, such as stocks, bonds, and real estate, you can reduce risk and minimize taxes on investment gains. Another tip is to consider using tax-efficient investment vehicles, such as index funds or ETFs, which tend to have lower turnover rates and generate fewer capital gains. You should also be mindful of your individual tax situation and how it impacts your investments. For instance, if you're in a high tax bracket, it may make sense to prioritize tax-deferred investments, such as 401s or IRA. Furthermore, research findings have shown that tax-efficient investing can have a significant impact on investment returns over time. According to a study by Morningstar, tax-efficient investors can potentially save up to 1% per year in taxes, which can translate into tens of thousands of dollars in savings over the course of a lifetime. To take it a step further, you can also use tools and resources such as tax software or investment platforms that offer tax optimization features. These tools can help you identify potential tax savings and provide guidance on how to optimize your portfolio. For example, the investment platform Betterment offers a range of tax-efficient investment strategies, including tax loss harvesting and tax-deferred investing. In conclusion, tax-efficient investment strategies is a powerful concept that can help you achieve your long-term financial goals while minimizing the impact of taxes on your investment. By understanding the core principles and theories, using real-world examples and case studies, and applying practical tips and strategies, you can take control of your investment journey and make informed decisions that drive success. Remember, every great business starts with action. Make your next move count by taking the first step towards implementing tax-efficient investment strategies in your own investments. Don't be afraid to seek advice, ask questions, and learn from others. With the right approach and mindset, you can achieve financial freedom and build a brighter future for yourself and your loved ones. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.